Let's go now to our friend Beimnet Abebe from Galaxy Trading. Beimnet, welcome as always to Galaxy Brains.
Thanks for having me, and welcome back from London.
Thank you. Yes, I was traveling. I went to Cheat Code in London, Peter McCormack. So we got the real Bedford FC banner over here. Very fun conference. Shout out to the whole team.
And now you're a real football fan.
I am. I've seen actual football be played. It was great. I am back, though. And while I was in London, however, there was a geopolitical event. That's weighed on markets. If you look over my shoulder, you see the block clock. Again, it's funny to be saying this at like 61K, but like I look at it, I see the number. I say to myself, bad number. It should be higher number. Anyway, we'll debate about what the causes were of that. But first, I know there's been there's been macro news and broader markets have been sliding as well now for several weeks, I think, right?
Yep.
What's going on?
So, one, in terms of sort of U.S. monetary policy, you've had a series of strong data prints with CPI, PPI, and those strong data prints have caused the Fed to kind of react. And more specifically, the commentary from Fed officials has moved from 3 cuts is appropriate this year, and that was what was in the dot plot, to 2 to 1. And now you're kind of pricing in like 1.5 cuts this year all in, and we started the year at 7. So the combination of this hawkish Fed speak and hot data has led to a major repricing in the U.S. interest rate curve, and yields across the entirety of the U.S. yield curve have all moved higher. And as a consequence, the dollar has gained a lot of value, particularly against EM countries like dollar China, dollar Korea, dollar Mex. G10 currency pairs are also been moving lower. Euro broke through 107, almost got through 106. And on top of that, what you're seeing in U.S. equity markets is also fairly notable. We've had breaks of the 50-day moving averages, basically 3 weeks of moving sideways and then down. And some of that weakness in equities is attributable to the bond price action, but there's another component to it which I think is also very relevant, which is kind of the deterioration of the U.S. consumer in a way, and the subsequent and likely deterioration of earnings. Right. There was a company today, a freight company, and they basically were like, this quarter our loads are down, and their expenses are also high because of things like car insurance, commodities, energy prices, and so their margins are getting squeezed because people want less stuff, and in order to do the exact same activity, the costs of that has gone up. And there are also a couple of consumer discretionary companies, retailers, that have given guidance recently, and that guidance has been not so great. And so there's actually genuine concern about the U.S. consumer.
Wow. But hadn't the consumer been remarkably strong for a while?
They had been remarkably strong. However, what's happening is inflation's actually starting to take a bite from their ability to consume. Right. And what that's related to is basically what I like to think of necessity inflation. Right? What are some of the components that are rising the hottest right now? Home insurance, car insurance, medical costs.
Things are, like, in many cases, mandated by law to buy.
Correct.
Right.
You literally,
also, gas prices.
Yes.
Right. We're all
You're feeling it. You look at like the Big Mac index. That's up a lot more than headline CPI.
No, I don't want to pick on them in specific. But remember there was the $5 foot long, and now there's the $6 6-inch.
That's inflation.
That's more expensive, and it's half. No, it really is true though. That's literally the sandwich that To be clear,
that's how I measure my inflation.
I'm just saying, like, it used to be $5 for 12 for a giant one, and now it's more expensive for half as much.
Yes.
But yes, so people are feeling it in food too.
Yeah, and so what's happening is that discretionary spending, that's taking a hit.
Yeah.
And people are already at sort of like lower savings rate and lower saving base in the U.S. because people have just been consuming so much, and wages aren't keeping up with inflation anymore.
So they're running out of money.
Yes.
They're not buying as much, so the earnings can be bad. But at the same time, inflation is still actually now rising again.
Correct.
So they can't cut as much, which means risk has been going down. It's pretty like
it's not a good picture.
It's not great. I want to give you your laurels a little bit here too. I think I mentioned this on last week's pod, but you've been saying for months that it shouldn't have been 7 cuts.
Yeah.
At the time, I recall you saying, well, first of all, just like even when the data was much better, you're like, there's no need for the cuts. Like the economy is doing well, and it's almost like, well, maybe you would. This is where they start to get into the rock and the hard place really bad, right? Because it's like, well, if the economy, the real economy, the everyday people, their costs, like their for their rent, their houses, their food, like maybe they need some relief, and like that could be cuts. But if you cut, maybe inflation goes higher.
Yeah, so they're dealing with an insane credibility issue right now. And so when Powell came out and was like, oh, we're still cutting 3, and we're like, it doesn't really make any sense to cut 3, right? Like the market is starting to challenge their credibility. And the way you see it challenged in markets is, some of this interest rate pricing. But what I like to look at as well is inflation sort of expectations and market-based inflation expectations. And basically, over the past couple of months, you've seen implied inflation tick higher and higher. And so the market was basically like calling, the Fed's bluff in a way, being like, guys, like, do you think doing what you're currently doing is going to cause, inflation to come down? No, the expectations started to move higher. And then you start getting into the terminal state of this, right? What does this look like a couple years from now? And the fiscal situation is really insane. Right now, I heard today that, it's April 20th, right? So we're probably 150 days into the year or something like that.
Yeah.
And the deficit's already $1.5 trillion. We're, I think, on pace for something
like 4?
No, like 2.5 on the year.
Oh, yeah,
which is still a lot. And I think that's what you're kind of seeing in like commodity prices right now. The gold, the silver charts are some of the most compelling things I've ever seen. Silver is about to be at I think it's around a 5-year high, and it's breaking out. Gold is obviously at fresh all-time highs, and that's in the face of a way stronger dollar, much higher real rates. And so you're seeing that correlation breakdown that we talked about in the context of Bitcoin.
Yeah.
But you're seeing that correlation breakdown in gold.
Yeah.
And like I'm literally
the world is basically like avoiding or dumping U.S. debt or buying, asking for for it to be cheaper.
Yes.
Yeah.
Exactly.
While paying more for gold. I mean,
yes.
Yeah.
And there are central banks buying this stuff. Like why it's so compelling is that these central banks that have money printers are using those money printers to buy real assets like gold and silver.
Huh.
And so that's why, like, if Bitcoin, like, if it is going to be in that realm of assets, real money, debasement hedges, it's got such a promising future.
Right.
Because the macro world is freaking out right now, and that's why gold is ripping.
All right, let's talk about Bitcoin and the crypto complex too, because I mean, Bitcoin is at these prices maybe like 18 or 20% off its all-time high, which was 73.8 or so, I guess only several weeks ago. I've written about this. That's actually extremely common during the major bull runs we've seen. It was like
30% correction.
Yeah, like 7 or 8 of them sometimes, right? Like so, like okay, like for context, that's fine. Also, it has dipped historically before the halving, which is in just a day or two away. But also the geopolitics, the Iranian retaliatory missile attack on Israel happened last Saturday. All the other world's markets are closed, basically. But Bitcoin was open, and it dropped significantly right on the headline, right?
Correct.
And but then I would say the market opened on Monday eventually. It was like, so did like Bitcoin? It was how much of this? Obviously, we sort of trending, below all-time highs before, but like, is this a reaction to? It's a risk asset. I am able to sell it over the weekend, and then Bitcoin sort of struggling to recover from that sale up in the 68, 69 area because people are like, well, maybe it was a little overheated. I mean, how do you think about where Bitcoin is, or is it sort of just kind of noise it's still at this point? I mean, to be clear, it's 61K is a nice, healthy, high Bitcoin price. But
I think last year we were here this time and we were talking
like 22.
Yeah. And so it's obviously had a huge run.
Yeah.
And that basically highlights the fact that there's a lot of long positioning in the asset.
Yeah.
And so I think what you've had over the past couple of weeks is just a healthy flush out of positioning, consolidation,
There was a large leverage wipeout
that
a lot of leverage came off,
Yeah. And so I think the trend is still intact. And I'm looking at, something like the 100-day moving average to kind of confirm to me that we're still trending higher. And that's right around 57K. So you still have a ton of room.
And a lot of people have said like 58 is a reasonable, like that would also make sense. Like,
yeah, no, totally
you just look
reasonable.
at the charts and stuff.
And I think like, sometimes it's better to look at the big picture charts, like look at the monthly candles and stuff, and, not get too caught up in the day-to-day noise.
And it is funny because like if you look at, like I said, if you look at 61 and you say, oh my gosh, that we're down.
Yeah.
Like you said, I mean, we were doing this pod in January 23. It was 16.6 or something, I think, in the first episode of the year last year. So, like, I mean,
yeah, and
it's
now
just
we have
psychology
a
the
whole new
way
buyer
people
base
think
and,
about
like,
it.
tons of like ETF inflows, more people interested than ever,
And a lot of those platforms that we've been talking about being the main net new accessible market, like the wealth advisors and the financial advisor platforms, they're still not turned on.
Yeah.
So, but it does seem like those just on the flows, we saw some incredible inflows. I think something like 14 or so billion in inflows, net inflows, not including or net of the grayscale outflows. That was before any of those platforms turned on. So I guess we assume, I mean, not that they weren't all institutions, but they were just people buying institutions too, but retail on like brokerage platforms, basically.
Yep.
Those have really sort of dried up over. It's been less every week for like the last 4 weeks. So has everyone now? This is an impossible question to ask, but it leads me to ask: has everyone now that apparently did want to get it through their brokerage account and could and did, like, there's no more dry powder there? It seems like retail has allocated.
Yeah, no, I think historically, if you look, some of this flow activity is related to tax season and stuff, and so. Typically I do think you start to see an uptick in retail involvement in risk markets in terms of like equity inflows and stuff. So there's a case to be made that, the people that got access to it have allocated already, but there's still so many people that don't have access, that so many platforms that haven't been turned on,
right?
Vanguards of the world.
So I mean, sort of like wave one maybe has played out a little bit, and like wave two is yet to happen. Like,
yeah,
maybe.
At the end of the day, I mean, it's like you just have to think about what your trade is when you're buying Bitcoin, and your trade is short dollars.
Yeah.
And I'm happily short dollars.
There you go, Beimnet Abebe, my friend from Galaxy Trading. Thanks for coming to Galaxy Experience.
Thank you.